The future of the HECM program can be found in California.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Welcome to the Great Unknown, everyone. If we're being honest with ourselves and others, not much really does seem certain these days. The likelihood of celebrating Thanksgiving in just a few days with your family and friends, planned holiday travel, and how you're going to be transacting business during what appears to be a strong second wave of the coronavirus pandemic. Yet a couple things are undeniable and actually established truths. More specifically, the valuation of FHA's Mutual Mortgage Insurance Fund, that of course backs traditional FHA loans, and the federally insured reverse mortgage, or the home equity conversion mortgage. It shows that it's extremely sensitive even to the most modest changes in home price appreciation. So don't blame the messenger, blame the math. Now, the mathematical assumptions is showing that a mere 1% drop in home appreciation reduces FHA's overall fund capitalization ratio by 1.3%. And if you apply a hypothetical stress test to FHA's report, it shows that market conditions similar to 2007 would completely erase the Mutual Mortgage Insurance Fund present positive 6% capitalization ratio down to a negative 0.63%. Now, knowing this, it's easy to understand the agency's reluctance in the past to grant repeated requests from housing lobbyists to further reduce FHA premiums. And it's also clear that a high capitalization ratio is a necessity to weather the storms of economic uncertainty. Now, today, much of that uncertainty is focused on the long-term impact of the coronavirus pandemic on the American economy, and more specifically, unemployment. After all, it is employment itself that is the linchpin of the housing market. It's very difficult for you to make a mortgage payment without having a full and reliable income. Now, though receiving less attention than the overall improvement of the fund's valuation, especially the HECM portion, there are some risks that we should really identify that are noted in the report that could boost future claims. And the first is the reversal of home price appreciation, or what I call a drop in values, triggered by a flood of distressed properties coming on the market. Now, FHA reports to have today over 900,000 loans in serious delinquency. That means those loans are over 90 days past due. Second, are more unemployed borrowers than we have projected. Now, those homeowners would place a strain on the FHA fund because they're not going to be eligible for loss mitigation measures because they have no means of resuming their monthly payments. Third, too many borrowers that are opting to take a full 12-month of mortgage forbearance under the CARES Act. There's 2 6-month forbearance periods. Now, if those all terminate in a short time, then we have a problem. Now, the report states a gradual unwinding of forbearance would be a preferred outcome, as it would be less likely to cause market disruptions. Now, 2 other market risks should be noted. Now, the first we should call the California factor. FHA's annual report to Congress notes that federally insured reverse mortgages are much more geographically concentrated than their traditional FHA counterparts. California alone represents just over 35% of all endorsed HECM loans when it's based on maximum claim amount. The other 25% of MCA volume, well, it comes from Florida, Colorado, Arizona, and Washington State. That means that 5 states account for 60% of HECM endorsements by maximum claim amount in 2020. As a result, future HECM performance will most likely be more reliant on economic factors, such as house price appreciation in these concentrated states, particularly in California, where the share of HECM MCA is almost 5 times greater than Colorado, the state with the second highest share at 7.38%. To monitor the future health of the HECM portion of FHA Insurance Fund, look to future home values in these states, especially California. Thus the California factor. Next week, we're going to examine the 2020 actuarial review, which the annual report to Congress is based on, and the HECM portion of the MMI fund. But more specifically, we're going to examine why, despite increasing home values and low interest rates, why are we seeing the HECM valuation actually drop significantly since the October 2017 HECM changes. We all remember those. So 2018, 19, and 20. In the meantime, we're going to leave you with the words of Seneca. The whole future lies in uncertainty. Live immediately. So let's find what can be accomplished today immediately and approach it with vigor and tenacity. I want to thank you for joining us and be sure to return next week. By the way, you can support our sponsor. That's Fairway Independent Mortgage. You can do so by clicking on their banner on this page. And also you can share this video with others using the social media links on this page. Don't forget, every Monday, you can get your reverse mortgage news on the go, whether you're on the car or in your office, by listening to our podcast, HECM World Weekly. Until then, have a great week and have a happy and safe Thanksgiving.